Wednesday, March 25th, 2026. 1 week earlier, Micron Technology had set an all-time high of $471. Then a blog post hit the internet, not from a competitor, not from a customer backing out of a deal, from Google Research, 12 pages of algorithm documentation. 8 trading days later, Micron had shed nearly 30% of its value. Over $30 billion gone. This isn't a story about a tech breakthrough. It's a story about an entire industry discovering their customers might not need them anymore. For 18 months, one trade on Wall Street had been consensus. AI needs memory. Endless, expensive, high bandwidth memory. Every time ChatGPT answers a question, it loads billions of parameters into working memory, specifically DRAM and high bandwidth memory chips. The bigger the model, the more memory it devours. Micron's entire bull case was built on this. Their stock had tripled since 2023, hitting that $471 all-time high on March 18th. Analysts at Morgan Stanley projected AI inference alone would drive $50 billion in new memory demand by 2028. Samsung and SK Hynix were racing to expand production capacity. The bottleneck wasn't training new AI models anymore, it was running them. Every query, every chatbot response, every AI-generated image required massive amounts of active memory to hold the model's working thoughts, what engineers call the KV cache. The math was simple. More AI usage equals more memory chips sold. Micron's CEO had called it the greatest demand cycle in semiconductor history. And then Google published a paper called TurboQuant. Here's the number that broke the narrative: 6 times compression. Google's algorithm reduces the memory required to run large language models by at least 6 times. Some configurations hit 8 times. Effectively, TurboQuant lets you run the same AI model on 83% less memory hardware. The scientists described it as theoretically grounded quantization, a way to compress the KV cache, that working memory bottleneck, without losing accuracy. Translation: you could run GPT-4 scale inference on 1/6 the number of memory chips. The market's reaction wasn't subtle. Micron fell roughly 8% the day of the announcement, then kept falling, down 18% by end of week, nearly 30% from peak by the time the selling stopped. The entire memory sector collapsed with it. This wasn't panic, this was recalculation. Every AI infrastructure investor was asking the same question. If Google can do this, what happens when Meta does it? When OpenAI does it? When every hyperscaler optimizes their models the same way? But here's where it gets strange. The sell-off happened even though analysts immediately pointed to the obvious counterargument, the Jevons paradox. The principle is simple. When you make something more efficient, people use more of it, not less. Cheaper AI inference means lower cost per query, which historically drives explosive adoption. Morgan Stanley published a note within hours. Lower inference costs reduce per token expense, which should expand AI deployment, not contract it. And this is the part nobody talks about. The Jevons paradox is already priced in. It's been the bull case for Micron since 2023. Every analyst presentation mentions it. Efficiency drives adoption drives demand. The market already believed that narrative. What Google proved is that the efficiency gains might come faster than the adoption curve. And Wall Street had priced in a decade of growth that assumed both happened at the same pace. Here's what everyone missed. TurboQuant doesn't just make inference cheaper. It decouples memory demand from model growth. A year ago, if you wanted to run a model twice as large, you needed twice the memory. Now you need 1/6 more. The relationship between AI usage and memory chips sold just broke. This is where it stops being a coincidence. Google released TurboQuant publicly, open sourced the algorithm. Every AI lab on Earth can now implement this. Within weeks, reports surfaced that Meta was testing similar compression techniques. OpenAI's infrastructure team was reportedly exploring quantization for GPT-5 inference. The technology isn't proprietary, it's inevitable. The trap has a name: extrapolation bias. Wall Street took one trend, AI models getting bigger, and extended it in a straight line. More parameters, more memory, more chips. The assumption was that hardware demand would scale linearly with model capability. But technology doesn't work that way. At some point, software eats the hardware margin. This happened before. In 2008, analysts projected data center power consumption would consume 10% of global electricity by 2020, based on usage trends. Then virtualization and power efficiency improvements made the forecast absurd. The pattern repeats. A new technology creates a hardware boom. Everyone prices in infinite demand. Then software optimization arrives, and the math changes overnight. In this pattern, it's happening right now, in memory, in the middle of the largest semiconductor investment cycle in history. Micron bounced. Within weeks, it had recovered a significant portion of those losses, as the market decided the Jevons paradox would save them after all. Cheaper inference would drive more usage. The chips would still get sold. Maybe they're right. Or maybe this is the moment everyone learns the difference between a trend and a law. Efficiency doesn't always increase consumption. Sometimes it just increases efficiency. And an entire industry priced in the opposite. If this is the kind of story you want to see more of, you know what to do.